Warren Buffett, often referred to as the Oracle of Omaha, is a testament to the success that can be achieved through disciplined and principled investing. With a career spanning over 6 decades, Buffett has not only built Berkshire Hathaway into a colossal conglomerate, but has also consistently beaten the market, amassing a personal fortune in the process. His investment philosophy, centered around value investing and intrinsic value, has inspired generations of investors. However, the wisdom encapsulated in his approach extends beyond mere investment strategies, offering timeless insights into business evaluation, risk management, and the psychological fortitude required in the financial markets. This video aims to demystify the 10 core principles that underpin Buffett's investment strategy, providing a comprehensive understanding that can empower individual investors to make informed decisions in the pursuit of their financial goals. Principle 1. Invest in what you know. One of the cornerstones of Warren Buffett's investment philosophy is the principle of investing in what you know, often encapsulated in the phrase circle of competence. This principle advocates for the importance of staying within one's areas of expertise and understanding when making investment decisions. Buffett himself has famously steered clear of industries and technologies outside his comprehensive understanding, such as the early internet tech boom, emphasizing that sticking to familiar territories minimizes risk and enhances decision-making quality. This approach does not mean investors should shy away from expanding their knowledge or exploring new sectors. Rather, it encourages a deep dive into industries where they possess or can develop a competitive edge in understanding. By doing so, investors can more accurately assess the potential and the pitfalls of their investments, making informed decisions based on sound reasoning rather than speculative trends. Practical application of this principle involves conducting thorough research and analysis of industries and companies, understanding business models, competitive landscapes, and market dynamics. It also means being honest about one's knowledge gaps and seeking to bridge them before making investment commitments. This disciplined approach to investment, rooted in knowledge and understanding, significantly reduces exposure to unnecessary risks and aligns investment decisions with one's own expertise and comfort level, paving the way for more successful and confident investment outcomes. Principle 2. The margin of safety. The margin of safety is a fundamental principle in value investing, emphasizing the importance of purchasing stocks at a significant discount to their intrinsic value. This approach provides a buffer against errors in judgment or unforeseen market downturns, thereby minimizing potential losses. Warren Buffett attributes much of his investment success to his unwavering commitment to this principle, which acts as a protective moat around each investment. Applying the margin of safety means rigorously analyzing a company's financial statements, understanding its business model, and estimating its intrinsic value based on future earnings potential. Investors should then only purchase the stock at its market price, is significantly lower than this calculated value. This difference represents the margin of safety, offering investors protection against market volatility and valuation errors. The practicality of the margin of safety lies in its dual function. It guards against losses, while also providing opportunities for substantial gains. Stocks bought at a considerable discount not only have limited downside due to their undervaluation, but also offer considerable upside potential as their prices correct upwards towards their intrinsic values. For Buffett, this principle is not merely a strategy, but a philosophy that prioritizes capital preservation while still seeking robust returns, embodying the adage, "Do not lose money." Principle 3. The circle of competence. Warren Buffett's circle of competence concept encourages investors to invest in businesses they understand deeply. This principle advises against stepping into unfamiliar territories without the requisite knowledge, as this can lead to misguided investment decisions. The circle of competence is about recognizing and operating within one's own skill set and knowledge base, thereby avoiding the pitfalls that come from venturing into unknown sectors or industries. Buffett's own investments reflect this principle. He has traditionally avoided industries he claims not to understand well, such as technology in the early days, focusing instead on companies with simple, straightforward business models. This focus enables an investor to make more informed and confident decisions, understanding the nuances of the businesses they invest in, from operational challenges to competitive advantages. To apply this principle, investors should start by conducting a self-assessment to identify areas where they have the most knowledge or can develop expertise. This involves understanding not just the products or services a company offers, but also its financial health, business strategies, and the broader industry landscape. Staying within this circle does not mean limiting one's potential for growth. Rather, it encourages a deep dive into familiar sectors, which can lead to discovering undervalued investment opportunities that others may overlook. Principle 4. The economic moat. The concept of an economic moat refers to a company's ability to maintain competitive advantages over its rivals, thereby protecting its market share and profitability over the long term. Warren Buffett places a high premium on companies with strong economic moats because they are better positioned to withstand competition and economic downturns. These moats can come in various forms, including brand recognition, patent protections, regulatory licenses, or a unique business model that is difficult for competitors to replicate. Investing in companies with economic moats involves identifying those unique traits that enable a business to generate above-average returns over extended periods. For Buffett, the presence of a moat is a key indicator of a company's long-term viability and profitability. He often cites examples like Coca-Cola and its brand strength, or See's Candies with its loyal customer base as quintessential examples of most rich companies. To leverage this principle, investors should look for companies that not only have a current competitive advantage, but also the ability to sustain and potentially expand that advantage over time. This requires a thorough analysis of the company's industry position, its competitors, and the durability of its competitive edge. Investing in such companies at a reasonable price is central to Buffett's strategy, as these businesses are likely to provide stable, growing returns over the long haul. Principle 5. Long-term investments. Warren Buffett is renowned for his long-term investment approach, famously stating that his favorite holding period is forever. This principle stems from the belief that holding onto investments for extended periods allows investors to reap the benefits of compound interest, business growth, and the inherent value appreciation of high-quality companies. It also reflects a conviction in the investments made, a belief that if a business is worth buying, it is worth holding onto, unless fundamental changes affect its intrinsic value. Long-term investing is antithetical to the speculative, short-term trading that characterizes much of today's market activity. It requires patience, discipline, and a deep understanding of the companies in one's portfolio. By focusing on the long term, investors can avoid the pitfalls of market timing and the costs associated with frequent trading, such as taxes and transaction fees. For individual investors looking to adopt this principle, it's important to conduct thorough due diligence before making any investment, focusing on the business's long-term prospects, financial health, and the sustainability of its competitive advantages. Once an investment is made, it's crucial to monitor the company's performance and the industry landscape, ensuring that the original reasons for the investment remain valid over time. Principle 6. Quality management. The quality of a company's management team is a critical factor in Warren Buffett's investment decisions. He believes that even the best business models can falter under poor leadership, while exceptional leaders can steer companies to success even in tough industries. Buffett looks for management teams characterized by integrity, skill, and a shareholder-oriented approach, assessing their performance not just on short-term financial metrics, but on their ability to create long-term value. Evaluating management involves examining their track record, their communication with shareholders, and their decision-making processes. Buffett values transparency, prudent capital allocation decisions, and a focus on building shareholder value over making decisions that might boost short-term earnings at the expense of long-term health. For investors, assessing management quality can be challenging, requiring a look beyond the numbers to understand the executive strategies, their execution capabilities, and how they navigate challenges. This might involve listening to earnings calls, reading annual reports, and analyzing past strategic decisions. Investing in companies with high-quality management teams can provide a level of assurance that the business is in good hands, aligning with Buffett's philosophy of long-term, value-oriented investing. Principle 7. Financial health and high ROE. Financial health and a high return on equity (ROE) are indicators of a company's efficiency in generating profits from every dollar of shareholders' equity. Warren Buffett emphasizes the importance of investing in companies that not only show robust financial health, but also demonstrate an ability to deliver high ROE consistently. This combination suggests that a company has a competitive advantage that it can leverage to create value for its shareholders over time. Buffett often points to ROE as a key metric in evaluating a company's performance, favoring businesses that can achieve high returns without excessive debt. A strong balance sheet, characterized by a solid foundation of assets relative to liabilities, and a consistent track record of profitability, are hallmarks of the financial health he seeks. Investors looking to follow this principle should focus on analyzing financial statements, understanding the components that drive ROE, and evaluating the company's debt levels. It's important to look for trends in these metrics over time, as they can indicate a company's operational efficiency and financial stability. Investing in companies that maintain strong financial health and high ROE can lead to superior returns, reflecting Buffett's approach to choosing investments that are likely you out. Principle 8. Avoid excessive debt. Excessive debt is a red flag in Warren Buffett's investment analysis. High levels of debt can jeopardize a company's financial stability and its ability to navigate economic downturns. Buffett advises investors to scrutinize a company's debt-to-equity ratio and its interest coverage ratio, which provide insights into the company's leverage and its ability to meet interest obligations. A company with manageable debt levels is more adaptable and has a greater capacity for investment in growth opportunities without risking financial distress. The rationale behind this principle is straightforward. Companies laden with debt are at a higher risk of bankruptcy during tough economic times. They also have less flexibility when it comes to pursuing growth initiatives or weathering downturns. Buffett's penchant for companies with little to no debt underscores his conservative conservative approach, prioritizing safety and stability in the investments he chooses. For investors, applying this principle means conducting a thorough review of a company's balance sheet, understanding the nature of a company's liabilities, the maturity profiles of its debts, and how its debt levels compare within the industry can provide a clearer picture of its financial health. Avoiding companies with unsustainable debt levels can protect investors from significant losses, aligning with Buffett's emphasis on capital preservation. Principle 9. Value investing versus speculation. Warren Buffett is a staunch advocate of value investing, a strategy that focuses on buying securities that appear underpriced by some form of fundamental analysis. This contrasts sharply with speculation, where purchase decisions are based on a bet regarding future prices without regard to the underlying business's fundamentals. Buffett's success has been built on identifying undervalued companies with strong potential for long-term growth, not on trying to time the market or chase hot stocks. Value investing requires patience, thorough research, and a disciplined approach to buying stocks that are trading for less than their intrinsic value. This method allows investors to capitalize on market overreactions or misunderstandings about a company's true worth. Buffett's approach involves calculating a company's intrinsic value based on its future cash flow potential and purchasing its stock at a price that offers a margin of safety. Investors wishing to follow Buffett's example should focus on learning how to evaluate a company's fundamentals, such as its earnings, growth potential, and financial health. By investing in companies with solid fundamentals at prices below their intrinsic value, investors can build a portfolio position for long-term growth, avoiding the pitfalls of speculative investing. Principle 10. Be fearful when others are greedy. This principle encapsulates Buffett's contrarian investment philosophy. Be fearful when others are greedy, and be greedy when others are fearful. It highlights the importance of going against market sentiment to find investment opportunities. When markets are overly optimistic and prices are high, risk increases, making it a time for caution. Conversely, during market downturns, when fear prevails and prices plummet, opportunities for buying undervalued stocks increase. Buffett's ability to maintain a level head and act counter to prevailing market emotions has been a key to his success. He sees market downturns not as threats, but as opportunities to purchase high-quality assets at a discount. This approach requires a strong understanding of a company's value, the conviction to act on one's analysis, and the emotional discipline to withstand market pressures. For individual investors, applying this principle means developing the ability to assess market conditions and investor sentiment, identifying discrepancies between a company's market price and its intrinsic value. It also involves cultivating the psychological resilience to make investment decisions based on rational analysis rather than emotional reactions to market movements. By being contrarian and focusing on long-term value, investors can capitalize on the market's inefficiencies to achieve superior returns. Warren Buffett's investment principles offer a blueprint for navigating the complexities of the stock market with wisdom and discipline. From understanding the importance of investing within one's circle of competence to recognizing the value of financial health and the power of contrarian thinking, these tenets provide a solid foundation for any investment strategy. Adopting Buffett's principles requires patience, thorough analysis, and an unwavering commitment to value over speculation. For individual investors, the journey to implementing these principles begins with education and a commitment to disciplined investment practices. By focusing on long-term growth, maintaining a keen eye for value, and exercising caution in times of market exuberance, investors can position themselves for success. Warren Buffett's legendary investment career serves not only as a testament to the effectiveness of these principles, but also as a guide for those looking to achieve financial prosperity through prudent and informed investing. If you found this deep dive into Warren Buffett's 10 investment principles enlightening and wish to navigate the complexities of wealth creation with wisdom and discipline, don't forget to like, share, and subscribe to World of Wealth Creation. Join our community for more insightful content that helps you make informed investment decisions, guided by the strategies of some of the most successful investors in history. Your engagement not only supports our channel, but also empowers you with knowledge to build a prosperous financial future. So hit that like button, share this video with your network, and subscribe to World of Wealth Creation for your weekly dose of financial wisdom. Let's embark on this journey of wealth creation together.